Picture this. It's March 2009. The world is teetering on the edge of a financial abyss. Giants of Wall Street have crumbled. The market has been in a freefall, an absolutely astonishing 57% from its peak. Every headline, every news report, every conversation is drenched in one word: disaster. This isn't just a downturn. It's a moment of pure, bone-chilling fear. And right in the middle of this chaos, two young investors, just starting out, find themselves at a crossroads. They're about to make a choice, a single decision that without them knowing it will define the rest of their financial lives.
So, let's really put ourselves in that moment. On paper, these two investors are identical. Both 27 years old. Both have $5,000 to their name. And both are staring down the barrel of the same terrifying market crash. Now, investor one, he sees the chaos, he sees the headlines screaming, "Sell!" and his survival instinct just completely takes over. He does what feels like the only rational thing to do. He sells. He moves everything to cash, telling himself, "I'll just wait until things calm down, until there's some certainty." But investor two, he feels that same knot of fear in his stomach. Every part of him is screaming, "Get out." But he takes a deep breath, and he chooses to do the exact opposite. He sticks with his plan. He keeps putting in his $500 month after agonizing month. It's just one fork in the road, but it's going to lead to two totally different worlds.
Now you might be thinking, okay, interesting story from 2009, but what does that have to do with me today? Well, here's the thing. This isn't a history lesson. This is a forecast. That same feeling of panic, those same screaming headlines, that same deep gut-wrenching feeling telling you to run for the hills, it's happening all over again. The exact same window of opportunity that created that life-altering gap between our two investors, it is creaking open right now. And the hard truth is, most people are about to make the exact same mistake investor number one did.
But before we can even talk about opportunity, we have to do something, well, a little uncomfortable. We have to look that fear directly in the eye. Because if you've been paying any attention to the world lately, you've probably felt it. That creeping dread when you think about your money. So let's dissect it. Let's perform an anatomy of that fear, because understanding why you're scared is the first step to not being controlled by it.
So what's actually fueling this panic? Well, here's the scenario. Tensions that have been simmering for years finally boil over. The Strait of Hormuz, think of it as the jugular vein for almost a fifth of the world's oil supply, is shut down. The effect is immediate. It's brutal. In just 1 month, oil prices explode by 63%, and the market, which hates uncertainty more than anything, completely loses its mind. The S&P 500 has its worst quarter in years. The Nasdaq plunges into a correction. And that CNN Fear and Greed Index, it's buried deep in the red zone of extreme fear. We're talking about a level of panic that we've only seen on a tiny fraction of trading days in the last decade. This is maximum fear.
And you have to admit, there's a logic to the fear, right? The media lays out this really convincing and really scary chain of dominoes. It starts with the oil spike. That's domino number one. That immediately means higher costs for everything, which then bleeds into the entire economy. Suddenly, it costs more to make things, more to ship things, and the price of food starts to climb. That's domino number two, inflation. Now this puts the Federal Reserve in a terrible spot. Domino number three, they're trapped. They can't cut interest rates to help the economy because that'll just make inflation worse. So what do you get when you mix rising prices with the slowing economy? You get the final dreaded domino, stagflation, the economic nightmare of the 1970s. That's the story being sold to us, and it sounds terrifyingly plausible. So, that's the narrative. That's the story driving all this panic. But this is the point where we have to stop, take a breath, and ask the most important question of all. Is that comparison even accurate? Is this moment, right now, really a repeat of the 1970s? Or is that just a really convenient and very effective story to make you afraid?
This right here is where that whole scary story just completely falls apart when you look at the facts. Comparing today's economy to 1974 is like saying someone has a terminal illness just because they have a headache. Yeah, there's one symptom that overlaps, but the underlying health is completely different. Let's just look. Back then, inflation was a wildfire at over 10% and rising. Today, it's around 2.7%. Unemployment was shooting towards 9%. Today, it's a super low 4.2%. Back then, the U.S. was totally dependent on foreign oil. Today, we're one of the biggest producers in the world. And here's the real kicker, productivity. In the 70s, it collapsed. Today, thanks to things like AI, it is surging at over 4%. The fundamental ingredients for that 1970s disaster, they're simply not here.
So if the headlines are telling us one story, it's time to listen to a much more reliable one. The story told by over 100 years of raw, unemotional data. This is where we have to quiet our gut feelings, turn off the shouting on TV, and look at what has actually happened, time and time again, during these moments of intense fear.
Okay, I want you to really let this sink in. An analysis looked at 20 major military conflicts going all the way back to the 1950s. We're talking everything from the Korean War to the Gulf War. And what it found was that the market's initial panic attack is incredibly short-lived. The average time it takes for the market to hit its absolute rock bottom point of fear, just 13 trading days. And the time it takes to get all of that back and return to where it started, a mere 28 trading days on average. This timeline really shows you just how fast that window of opportunity can slam shut. We're talking about less than 6 weeks. In less time than it takes for the seasons to change, the entire cycle of panic and recovery is often completely over. Think about that. While most people are still glued to the news, agonizing and waiting for that feeling of certainty, the recovery has already happened. The investors who stayed put, they captured all of that bounce back. The people who went to cash, they just locked in their losses and missed the whole thing.
And if we zoom out even further, the picture gets even clearer. Let's look at the long-term market cycles. The average bull market, the good times, lasts for almost 5 years and delivers a massive 177% return. Now, what about the bear markets, the scary times, like right now? Well, they're painful for sure, but they're also short, lasting about a year and a half with an average drop of around 35%. The difference between those two is just staggering. The periods of growth are exponentially longer and more powerful than the periods of fear. It's not even a fair fight.
100%. That's not a prediction, that's a fact from the entire history of the S&P 500. It is the percentage of every single 20-year period in recorded history that ended with a positive return. Let me say that again. Every single one. That includes the periods with World War I, the Great Depression, World War II, the 70s stagflation, the dot-com bust, and the 2008 financial crisis. The number of 20-year periods where you would have lost money by staying invested? Zero. None. Not a single one.
Okay, so all of this data brings us to a really uncomfortable question. If the historical evidence is this clear, why do so many smart people get it so wrong, time after time? Why do we always seem to sell at the absolute worst moment? The answer isn't in a finance textbook. The answer is much closer. It's inside our own heads.
Right? This is the maddening paradox of investing. We have decades of overwhelming proof that points to a simple, winning strategy. And yet, our own instincts, our own gut feelings are constantly yanking us in the complete opposite direction. It turns out our brains aren't just unhelpful here, they are hardwired to make us do the worst possible thing at the worst possible time.
And the reason why has a name. It's called loss aversion. Nobel Prize-winning research proved that the pain you feel from losing $1 is about twice as powerful as the pleasure you feel from gaining $1. Think about that. This isn't some personal flaw, it's an ancient survival mechanism. Our ancestors who survived weren't the optimists, they were the ones who were terrified of losing their food supply. And that same primitive wiring is in your brain right now, watching your portfolio turn red and screaming at you, make the pain stop.
And this chart, this shows the absolutely devastating, real-world cost of listening to that ancient voice in your head. For 30 years, a company called Dalbar has tracked the gap between what the stock market actually returned and what the average person actually earned. The results are just heartbreaking. Over 3 decades, the S&P 500 averaged a 10.35% return. The average investor, they only got 3.66%. That massive gap, that nearly 7% you see every single year, that's the price of emotion. It is the real-world cost of listening to your fear instead of the data.
And here's how that happens. When you sell to wait it out, you inevitably miss the most powerful days of the recovery. JP Morgan did this incredible study. They found that if you put 10 grand in the market and just left it alone for 20 years, it would have grown to almost $65,000. But if, during that same time, we're talking over 5,000 days, you missed just the 10 best days, your final return was cut in half. Missed the 30 best days, and you barely even kept up with inflation. All for nothing.
And here it is. This is the single most important part of this whole section. So where do those best days, the days that make or break your entire long-term return, where do they happen? The data is crystal clear. The vast majority of them happen when things feel the absolute worst. They happen deep in a bear market or in the first 2 months of the new recovery. Which means if you are sitting on the sidelines in cash waiting for the all-clear signal, you will have already missed them, and you can never get them back.
Okay, so we've looked at the fear, we've looked at the data, we understand the psychological traps. So the big question is, what do we actually do? How do we turn this knowledge into a real plan? Now let's be clear. This is not about trying to perfectly time the bottom. Anyone who tells you they can do that is lying. This is about having a simple, logical framework that works no matter what happens next.
Here it is, a simple three-part plan. Part 1 is the foundation. This is where 40 to 50% of your money goes, into a broad, low-cost S&P 500 index fund. With this one move, you're buying a small piece of the 500 biggest companies in America. You're betting on the entire engine of the economy, and right now, that engine is on sale. Part 2 is the accelerator. On top of that foundation, you can layer in individual world-class companies you believe in. The Microsofts, the Amazons, these are incredible businesses whose stock prices are being set by fear, not by their performance. And Part 3 is the engine that makes it all run. Discipline. You stick to the plan. You keep investing every single month. And if you can, you actually invest more when the market is down because you know you're getting a discount.
The math behind this is just beautiful. Let's say you invest $500 a month. When the market drops 30%, that same $500 now buys you 43% more ownership in these great companies than it did just a few months ago. If the market drops 40%, you're getting 67% more shares for every single dollar. You're not losing. You are actively accelerating your future wealth at a huge discount. That is the secret.
And that brings us all the way back to where we started. Back to that fearful day in March 2009, our two investors at a fork in the road. So, what happened? Let's fast forward to 2020. Investor 1, the one who went to cash to wait for certainty, he turned his $5,000 into about $18,000. Not bad. But what about Investor 2, the one who felt the same fear but stuck to the plan? His initial $5,000 plus his regular contributions had grown to over $210,000. The difference isn't just big, it's life-changing.
And this right here is the lesson. The enormous gap in wealth between those two people, it had nothing to do with being smarter. It wasn't about some secret stock tip. It was simply about having the courage to look at what the data proved to be true and to act on that logic when every instinct in your body and every headline on TV was screaming to do the opposite. That gap between knowing the right thing to do and actually doing it is where generational wealth is either built or lost forever.
Generational buying opportunities, by their very nature, only show up when things feel terrible. They only open up under conditions of extreme fear when portfolios are bleeding red and nobody knows what's going to happen next. But it's those exact conditions that create once-in-a-decade discounts, and they never last long. The 2009 window was open for a few months. The COVID crash window was open for a few weeks. This window, this opportunity, is open right now. So the only question that matters is the one you have to ask yourself. Which path will you choose?